Hello, everybody. We're going to go ahead and for today, we're going to talk about Chapter 17, Statement of Cash Flow, a little bit more in detail. You'll prepare Statement of Cash Flows in a lot more detail in your intermediate courses, but for the Principles course, we still will prepare one. As you think about the Statement of Cash Flow, it's really broken into three sections, and the way which I learned was just OIF, it's Operating, Investing, and Financing. The operating section is exactly what you expect it to be. It's basically the cash associated with operating the business. The investing section is exactly what you expect it to be. If I'm really looking towards property, plant, and equipment, long-term investments, really it's how I'm going to structure the business in the long run. And of course, financing, the very last section, really has more to do with the issuance of stock than anything else. If you really think about it, we spend a lot more time on the operating, the O section, than anything else, because it's the normal, ongoing, day-to-day cash operations that we have to use for a business. If you think about it in general, where does your cash go? After you have the sale in, we get our cash. Where does it go? Well, I've got to pay salaries. I have to pay advertising expense. I've got to pay utilities. I have to pay rent. All these sections, that's where my cash goes to one point in time. And it's very easy, as we've talked previously, to basically run out of cash very quickly. But getting back to, as we prepare the statement of cash flow, we traditionally start with our income statement. Now, if you remember back, our income statement is our sales less cost of goods sold, my gross margin less my selling and general expenses, is basically all the way down. But in the preparation of the statement of cash flow, we're going to go ahead and we're going to start with our income statement. What we do is then we add back the non-cash expenses. So what do we say when we talk about non-cash expense? If you remember back to your Principles 1 days, the non-cash expenses are depreciation and amortization. And the reason why they're just paper expenses. We get the benefit of an expense. We get the good guy basically pulling down our income, but it is not a true cash outflow. So keep in mind our income statement, we will be adding back the non-cash expense. Like we'll take whatever our net income is, we'll add back to it the amount for depreciation, we'll add back the amount for amortization, because once again, those are non-cash expenses. They're just paper expenses. Traditionally, if you think of an expense in general, a salary expense, you'll have a debit to salary expense, and you'll have a credit to cash, right? So we're actually paying cash. But when it comes to the non-cash expense, such as depreciation, amortization, there is no cash. It's just paper. So we'll start with our net income. We'll add back our non-cash amortization, depreciation. We'll add those back, and then we'll make the adjustments for accounts receivable, accounts payable. Really, the adjustments in general, and your book does a pretty great job of going through those. So I just encourage you to look through the book and see what we're talking about. So, for example, if you think about accounts receivable, if accounts receivable is going up from one period to another, that's unfortunately going to have a negative impact on cash. Well, what that means is that my AR, my IOUs are going up. And if my AR, my IOUs are going up, then of course that means I'm not really getting the cash that I needed. So cash is going to have an unfavorable impact. On a similar, if we think about accounts payable, if my accounts payable is declining from one period to another, then of course what's that mean? Well, the only way my payables can decline is that I actually paid off, I paid cash, I paid my payables. Therefore, it's going to have an unfavorable impact to cash. And your book does a really great job. If you look through each of those sections, it goes into great detail for it. In a similar fashion, you think about inventory, right? In general, if I'm paying cash for my inventory goes up, assuming it's not related to a payable. Well, how do I get more inventory? Well, I have to buy it. And how do I finance it? I pay cash for it. Just all those. And we're going to take it all the way through. And to keep in mind is that, after we make all those adjustments, that's going to be ending your statement of cash flow. Statement of cash flow is a very big financial statement. Traditionally, if you remember back to your Principles of Accounting days, we focused on 4 financial statements: income statement, statement of change retained earnings, balance sheet, and statement of cash flow. Income statement, of course, just shows your revenues and expenses. Your statement of change retained earnings is basically your cumulative profit and loss since the inception of the business. And the balance sheet, of course, is exactly that. It's your assets, liabilities, and owner's equity at a point in time. And of course, our last one is the statement of cash flow. Now, traditionally, it all depends on which school of thought you belong to and how you think about accounting. When I was a student, I thought the income statement was the greatest statement of all, and I didn't really spend a lot of attention or time on cash flow or balance sheet. To me, I thought, okay, I can see where my sales are coming in, I can see where my expenses are. I can go back through, and it really, of course, it's deriving to me my margin, how I'm running my business. Am I profitable? Am I not? So my attention was always on the income statement. And that's where I did all my analysis. I mean, I looked at the cost, I looked at what we're spending for rent. One of the biggest things that when small businesses start, they jump too quickly into a new facility, a new building, and they really indebt themselves for this new place because rent, of course, is a fixed cost. And similarly, I look at people. At any one business, we can look at the number of people, we can look how efficient they are, we can look at their tasks, we can see, hey, do we need them or not? So we're always continuing to evaluate people. People are expensive. Even if I have somebody in customer service, it's a $40,000 a year job, rough numbers. I add 15% on top of that for benefits, which, quick and dirty math, is going to be around $47,000. We need to make sure that person is generating enough benefit to justify their salary. And we really continue to look at every single role that exists and just make those evaluations. Purely from a business side point, we love to hire more salespeople because you have more salespeople. Salespeople does exactly what they say. They sell, right? They're bringing in additional revenue. We love that. And we, for the most part, want to delay, we want to slow down the hiring of customer service, administrative tasks, things of that nature. Our focus is always on salespeople, something which is going to add value to the business. Anyway, but I digress. But I focused on the income statement, and that was really my pure analysis was on that. And that was really until about 2 jobs ago. And at that point in time, I took a director of finance role at a large German company. And their income statement looked great, right? They were showed true profitability. Everything was looking great. But I spent the time to go back through and look at their balance sheet. And what I found was, as opposed to allowing their expenses to come through in a timely fashion, they were hanging them up on the balance sheet and not writing them off. So what that means that although they were only allowing certain expenses to be passed from month to month, and any of the expenses beyond a certain point, beyond what they expect, they're simply just going to set it right there on their balance sheet, and they're not going to write it off. And digging through, and it took a while. I mean, looking through every balance sheet account, seeing what is valid, there was over $1.1 million of items which had to be written off. That should have been in their income statement the entire time, but they had tied up in their balance sheet. So we had to make an adjustment, a one-time adjustment, and restate basically the full year of $1.1 million, which pure bottom line impact. And not less to say, the people were very unhappy. The CEO and the CFO at that point in time, really, they let them go. It was pretty big thing. But at that point in time, I learned to look not only at the income statement, but also look at the balance sheet. Remember, the balance sheet shows our assets, liabilities, and owner's equity. And our accounting theory, we can tie things up, we can put things on the balance sheet, but it has to have a life greater than at least 2 periods, 2 months, preferably more than that. But if I have a cost that's going to be over 2 months, I can spread that cost over 2 months. Let 1 month hit the expense, put 1 month on the balance sheet. The following month, let that pull that 1 month from the balance sheet and let it hit expenses. it's part of the matching principle. So in perfect theory, I can tie some minor things up to the balance sheet, but we have to be very careful. We have to follow the rules that are set aside by the generally accepted accounting principles. And the only way I can put it on the balance sheet is if it has a basically useful life more than 2 months. But even then, I have to continually, ensure that I'm actively engaged and I'm writing off expenses. Operating expenses, normal ongoing operational cost, those hit the income statement. If I'm buying like a piece of equipment, something larger, something where like a prepaid rent, I can tie that up on the balance sheet for, if it's I prepay the rent for 6 months, I can tie it up on the balance sheet for 6 months. But every month that passes, I have to write it off, little bits at a time. All right. Talk to you soon on chapter 18. Okay, bye.